I'm Giselle Herrera. I'm currently one of the managers for our location for here in Lee County. And I manage a small team, so I'm at the branch. I focus on obviously taking applications. I see members on a daily basis. So I'm usually the first person that you see when you come into a branch and you have questions about credit, or if you have questions about applying for credit. On the With the credit union, I've been with the credit union for now going on 7 years. So I've been able to see many questions and many scenarios on credit, building credit, why you're using credit, and the importance of it. So if you guys want, go ahead and drop in the chat the reasons why you may be joining the workshop, maybe some questions that you may have, or maybe some things that you've heard about credit that you don't fully understand, or maybe something that you have a question about and we can answer it, and maybe we may be able to answer it during the presentation. So on here, all right, so kind of going understanding credit. So in this workshop, we'll be able to cover over some of the things that may impact your credit, how to qualify, how your credit score is scored, the impact that it makes on money management, and what the future of credit upholds for you and yourself in your financial well-being. So we'll be able to go over things, like I said. If you want to go ahead and just drop it in the chat, and please feel free, we'll be able to answer those through the presentation. The first thing that we're going to go over is, why does credit matter? So obviously credit, there's different types of credits that you can apply for. There's car loans, mortgages, credit cards, personal loans. Obviously car loans is one of the biggest things right now for purchasing either your first vehicle, or if you're refinancing your vehicle. Obviously, there's different options that you have as well. Mortgages, buying your first home. Credit cards, maybe you're looking into building your credit. And then we also have personal loans as well as insurance costs. A lot of insurance companies will look at your credit to be able to see if they can give you a low cost of insurance. Employment opportunities. A lot of the times you may see that when you apply for an employer, they will ask you to have your credit pulled to see if you're a candidate for that position. Then you have housing options. If you're renting right now, you probably had your credit pulled to kind of understand if you're able to afford that rent each month.
And then just to kind of talk about just credit in general and why it's important to have good credit. Whenever you are looking to open up these car loans, mortgages, credit cards, and personal loans, they do look to see if you have maybe a higher score to give you the best interest rate. So that's one of those reasons why it's very important to keep that credit as high as possible so that you can pay less in the end. Again, also with the insurance costs and the employers, there might be an opportunity where you're looking to have or apply for a certain job and maybe not get that opportunity because your credit isn't too high or you have certain things onto your credit. So it is important to keep those credit scores up there for that purposes. And we do have Ashley joining us, and she will probably pick up from where Giselle has finished off.
So we're going to go ahead into the next slide, and we're going to go over to the credit report. So obviously, going back into those products that we're looking at that requires your credit to be pulled, will be mostly going off of this report here. So the three major credit bureaus where you can get a legitimate credit report is going to be Equifax, Experian, and TransUnion. So whether you go and apply for a vehicle loan, whether you go and apply for a home loan, they will pull from one of these three credit bureaus or from all three. With the bureaus, what they do is they compile all this information in regards of your payment history, your records, public records such as like your address, personal information, social security numbers, and then inquiries. So the inquiry is going to be whenever somebody pulls your credit, it will show up on your credit report. This is just to keep track to see where you have applied and if you have applied for previous credit. On the credit report, it is very important that the information is reporting accurately. So making sure that you're staying on top of everything and making sure that the on-time payments are being reported correctly. If there is something showing late and it shouldn't be, maybe that's something that we want to go ahead and question and figure out if it is accurate information. A lot of the times these credit reports, they're being used to have you be eligible for certain loans, or going back to housing options as well. These are things that can affect you on your credit report. So it is very important to make sure that the credit bureaus are reporting the most accurate information as best as possible, from everything from payment history, public records, and all that good information. Jennifer, did you want to add anything to that?
Nope, but we do have something in the chat, and it says, when an employer is checking your credit, is it considered a hard or soft inquiry? So it is a soft inquiry. They're not pulling necessarily to see your credit score. They're more checking to see more of that public record aspect of it, to see what kind of things, if you have some kind of what are those the things that maybe you were having some, what is it? I'm losing the word. When you have something in your credit, maybe from child support or from a lien that you might have. So they're looking more so on that aspect of it, not your credit, to see how high your credit is, but if there's something in your public records.
And another thing to add to that as well is that you'll see on your credit report as well previous employers that you may have had, as well as the time frame of when you were in that employer. So it's very possible that they can ask you a question in regards of, hey, I noticed that you had this employer on your credit report. I don't see it on your resume. So that may be a question that may come from that credit report as well, because again, it is public records that is being published on your credit report. So now going over the time on your credit report as well. A lot of these items may last for a very long period of time, and I'll go over each bullet point as well to kind of give you some information. Most of the negative information is reported for 7 years. Now, what type of negative information? We're looking at late payments, collections, charge-offs, bankruptcies, anything that has to do negatively that was not paid on time or paid at all will be reported as negative information on your credit bureau, For the Chapter 7 bankruptcy, so it will report for 10 years on your credit report. Collection accounts will report 7 years from date of first delinquency on an original account. So that first late payment that you had, and that it goes in as a collection, it will report 7 years from there, not from when you opened it, and it won't be from anything that you had your last late payment on. It will be as if it's reported from the date first of delinquency on the credit report. Now, positive information can remain indefinitely. So all those on-time payments, those paid off accounts, credit cards, and mortgages will report on your credit report, and that will obviously help you maintain that great credit history. Now, the FICO score, also known as your credit score as well, emphasizes last 2 years. So within the 24-year period, both positive and negative history will calculate what your credit score is now. So it is very important that anything recent or within those last 2 years are accurate and updated, and making sure that you're maintaining that good positive history.
And in the same way, it is important to say the power of time, that if maybe at one point you had a late payment, just because you had a late payment in the past doesn't mean that it's going to stay on your credit report forever. So that is a positive note, and it is important to just realize that maybe at one point you did have a late payment on your mortgage, and that was something that was negative, but as time goes on, the effect on it becomes less and less.
Now we're going to go to how the score is on your credit. So FICO scores can range from 300 to as low as 300 to as high as 850. So the score is based on many, many different factors to the type of credit that you use. So that's showing your loans, personal loans, car loans, mortgages, credit cards. Then you have payment history. How well have you paid? How long have you paid? Then you have amounts owed. Is your balances too high or are they very low? Looking at the amount that you owed. Then you got the length of credit history, whether you've only had credit for 6 months or have you had credit for the past 7 years. The same thing that goes in with new credit, that also goes over with the length of credit history. Having new credit for a short period amount of time and maybe you're jumping into a new loan, they're going to be looking at how well you've paid your previous history. And sometimes if it's too short, they may ask for a longer period of history on your credit. Now, on here, obviously payment history is about 35%. Then you have amounts owed is about 30%. Length of credit history is 15%. New credit is 10%, and then types of credit used is 10% as well. So you want to make sure that you're looking at all types of credits. And one thing that is not focused on here is inquiries. Inquiries, whenever your credit gets pulled, that means that there's an inquiry that does drop your credit score points down when you apply for any type of credit. So whether you are applying for an auto loan, a credit card, a mortgage, this will affect your score when you are applying. And this inquiry won't negatively affect you for a long period of time, like Jennifer had mentioned. It will go back up as you continue to pay your accounts on time, but it does affect you at that time when you are applying for new credit. Now, with the FICO score 300 to 850, obviously depending on what type of credit that you're using, the more that you use it and the balances that you owe comparable to your income will affect those score ranges as well. Jennifer, did you want to add anything to that?
Nope. Yep. That's about it. So it's important to just realize that it's all a balance. So when we're looking at the types of credit used, that can be anywhere from not just having credit cards, but having credit cards and vehicle loans and mortgages. So just having just a diversity and thinking of a credit score almost like a report card. It's basically where lenders can look and see and say, well, they were trusted and used their credit card responsibly with this limit, or they were able to pay off their vehicle and it was a vehicle for $30,000. So can we trust them with a little bit more? So they look at all those aspects, how long you had that vehicle and how much you paid on it. So again, like a credit or a report card that we are so familiar with. So they're just saying, okay, yeah, I think that they will be able to use this money responsibly.
So now going into affecting, what your credit score and how to maintain it and how to increase it. So improving your FICO score, repaying old delinquencies. Delinquencies, again, is just going over the negative impacted items on your credit report. Again, late payments, bankruptcy, collections. Then we always want to pay constantly on time. Keeping balance that you owe on your credit cards and personal loans significantly lower than the limit, about 50% or less. Keeping your oldest accounts active. So if you had a credit card way for I want to say 5 years and you said, nope, I'm not going to use it, my suggestion is that you keep that open. Reason being is because you have that history and it's showing a long period of time. Then limit the number of accounts, of open accounts, and limiting number of credit applications made. Now, repaying old delinquencies, even though they did affect your credit score previously, there's still ways of continuing to increase it. So repaying old delinquencies, paying them back on time, and continuing to pay constantly. Then your balances. So let's say that you have a credit card or a line of credit and your balance, or excuse me, your limit is currently $2,000. So you want to be 50% or less of that. So my suggestion is that you have a limit of 2,000, is that you keep the balance at $1,000 or less, making sure that you keep a low balance on the credit card. That way it doesn't look like you're either maxing out your lines of credits or your credit cards, to making sure that you're sustaining a good amount of debt. Again, going back to keeping your oldest accounts active, even if you're not using the credit card or if you're not using a line of credit, my suggestion is that if you've kept it open for a very long time, keep it open. Maybe you don't use it as often, or maybe just use it for small things, gas, groceries, making sure that you're keeping that movement that you've had for those period of times to keep that new credit, because the older the credit, the better your score will be. And then going on to limit numbers of open accounts. With the open accounts that you have, opening too many accounts at once can affect your score and does not let it grow to be as high as possible. Because, like, going back into the inquiries, if you're opening up a credit card this month, then next week you open up another credit card, then you open up another credit card. Now you have 3 inquiries on your credit report. Each inquiry pulled your credit, you have new credit, and it's not giving it enough time for you to pay back, letting it affect your score and not letting it grow like it should. So we want to limit how much we're pulling our credit and giving it time to grow by paying it back and giving it more time, so that way your credit score can keep increasing. It won't be able to increase if we keep pushing it back down with those inquiries. Then with the limit number of credit applications made, again, going back to the inquiries, we want to make sure that you're letting your credit score grow. Opening too much credit is not going to enhance it. A lot of the misconception with credit is stating, oh, I'm going to open all these credit cards so that way I can use them and that way my credit can continue to build. No, my suggestion is that if you have a credit card or two, you want to make sure that you're using those, and you want to make sure that you're using it the less of that 50%. So that way you have only 2 main cards, you're using it, you have them less than the 50%, and they're constantly being used and they're open for a longer period of time. That will help your credit score increase. Again, same thing with if you're applying for car loans or mortgages, you want to make sure that you're giving your credit score time before placing another inquiry on your credit report. Jennifer, did you want to add anything to that?
So yeah, so same thing, just reiterating those credit cards that you might have had when you were younger. Sometimes we're very tempted to just go ahead and close those out because we're not using, and yes, because you don't monitor it or whatever the case may be. But sometimes with closing out those older cards, it shows your oldest trade line going down, and then if it's closed out, then it's not able to be used as a length of time. So when that is an important factor that they look at, the length of time in which you've had that trade line. So whenever you're closing those out, just be careful, try to keep them open. As she said, just keeping maybe a minimum on it, paying it off, monitoring it, making sure that nothing weird is going on it. And then just being careful not to max out your credit. I know sometimes, or whenever you max out your credit card, that really does plunge your credit. So just making sure that you stay within that 30 to 50% range of your credit limit.
Then going back, establishing and reestablishing your credit. So going back to what we had previously stated, so obviously prepaying old debts, whether it's payment arrangements or settlements. A lot of the times, there's also another misconception where if your account is not paid and it goes straight to collections, you don't have to worry about it. Unfortunately, it's still going to report on your credit as an open collection, saying that you still have this open debt that you have yet to pay back. So you can either still set up payment arrangements with the collection companies. You can also offer settlements. Payment arrangements, you can ask these companies to either go off something that you may find financially capable of, whether it's, hey, I can contribute $50 each paycheck until this debt is paid in full, or whatever is easiest for yourself. Then you have settlements. Settlements will be, let's say that you have a collection for $1,000, but you want to settle this right away. You ask the financing company and you ask them, would you be able to take $800? So $200 in what you owe. However, a lot of the times these finance companies will take what you offer and pay off the account in full. And they'll show it on the credit report as closed, but you paid a majority of the amount and you guys came to a settlement, and this will report somewhat positively on your credit report if you're not able to pay the full amount right away. Another option for building credit is getting a secured credit card. Now, with the regular credit cards, you're not putting anything down. So let's say that you may not qualify for a regular credit card yet. Your other option is getting a secured credit card. Secured credit card, you're putting a certain amount of funds down. It's almost like a prepaid card. So for example, let's say that you wanted to apply for a $500 secured credit card. You'll put $500 down for the secured credit card and you'll get a card, and you're basically using your own funds to continue to build your credit. So it's still very important that we're making the payments on time, that we're staying below that 50% or less to make sure that you're using your credit wisely. And this will continue to help your score grow. After the period that you've had the secured credit card, of course, you can definitely apply at a later point once you've had that secured credit card for a good period amount of time before applying for a regular credit card. Getting a cosigner for a loan or a credit card. Maybe you have a parent or a family member that has great credit and you ask them to co-sign for a loan for a credit card. This will help you obtain the loan or the credit card so that way you can build your credit based on the type of loan that you get. Now, we want to be conscious of this as well, because letting the cosigner know that this does affect their credit as well. If you are late, or if you co-sign for somebody else as well, if they're late, this will affect your credit score, showing the late payment under your credit. Whether you're a cosigner or not, it's still going to report as if you were delinquent or default on this loan. Then lastly, keeping your credit report accurate. Unfortunately, there's mistakes that can happen, and certain items can be reported to the credit bureau incorrectly. Our suggestion is that every year that you take the time to look at your credit report and making sure that all the information is reported accurately, making sure that any inquiries that were on the credit report were truly yours. We also suggest checking your payments, and then also checking your balances as well, making sure that the accounts that should be open and should be closed should be open and should be closed. So making sure that you do that on an annual basis, maybe just doing it a certain period of time so that way you never forget, just making sure that it's always accurate, just so that way your score is reporting the best to have the best score possible. So now going on to beware of the credit repair. So a lot of people may come up to you and let you know that, hey, I had a credit repair company can fix your credit. I just paid them this lump sum amount and they took everything on my credit. So it is very important to know that credit repair companies cannot legally do anything you cannot do yourself for free. You can report anything on your credit report incorrectly, or calling collection companies yourself. Now, we just want to be careful, because a lot of these places, it could be a legitimate company, but there are many places that can be a scam as well. So my suggestion is that if you can do it yourself for free, take the steps yourself to dispute any incorrect information or outdated information. Same thing as late payments. If you truly believe that it should have not been a late payment, contact a finance company or contact a collection company, and you'll be able to dispute that or settle it with them as well.
And an important thing to note is that sometimes these credit report companies, they do this, we promise to increase your credit 100 points. And occasionally it seems almost too good to be true. And a lot of the times it is. So like she said, there's really nothing that you can't do or you can't do yourself that these credit companies are doing. So just do your research, maybe go in and try to do it yourself. Sometimes what ends up happening, it's almost like a temporary fix. They put a Band-Aid over it. They put a bunch of disputes in for you. And for the moment being, your credit does go up because all of these items are in dispute. but the credit companies will come around and they will say, hey, this is actually an accurate thing. So it's not something that you can dispute. If it's something that was, it is not something they can dispute. So sometimes that's kind of that temporary fix where they dispute all of your transactions, and for the moment being, they're all off of your account and it looks good. But eventually, if you put duct tape over that it's gonna come out eventually again. So it's just keeping in mind that it's just a temporary fix. It is a Band-Aid over it and it's not actually fixing it. So sometimes that's why it's better to kind of take matters into your own hands. It might be a little bit more stressful, but at least you know what's going on.
Well said,
Thank you.
Jennifer. So that brings us to the role of money management, and how we see ourselves at learning money management is extremely vital to creating realistic goals for spending, right? A spending plan helps us understand how to avoid credit and use it as supplement income. So we'll talk about these points 1 through 3. First things first, timely payments. We've just learned about how no payments affects our credit score and what that turns our FICO into. So timely payments helps us arrange for that credit score to boost on its own, nothing to do more on your part. And cash for settlements or paying off collection accounts, like we just learned, extremely crucial to that growth of that credit score, so that the borrower, the lenders involved in future asking of finance see that intent. It shows character from a financial institution standpoint. It shows that we are seeing you grow that and you care about making your payments. So much of your score is also based on your payment history, and you'll know that good management and a good management system for how you handle when things are due shows up in your credit score makeup. And we know that as making good payments. And third, saving for emergencies instead of turning to credit. You know, we all have our emergencies, right? We all have those rainy days, and it's helpful to go to our savings first instead of our credit. And I think that if we can change those mindsets about, well, I need credit for those rainy days versus how can I increase my savings and how can I make my savings count for those rainy days versus bringing out those loans, can also be a good way for you to play a role with this so that you can use that safety of credit less. It does take 3 to 6 months worth of unnecessary expenses, sorry, to be saved. And that's just a good number for what we say is helpful when you are looking to how much should I save, right? So 3 to 6 months worth should cover all of your expenses. It should, you know, include expenses for everyone in the household. That would be a good goal, a very reasonable goal for how to build off of that emergency should you need it for those moments. Jennifer, do you have anything to add about that?
Yeah, so I would say that the most important note to take away is to always ask first. I know sometimes people are very hesitant, especially when they are going through hard times and they think, oh, that financial institution isn't going to do anything. But sometimes when you are foreseeing that maybe some financial struggle or hardship is coming in the foreseeable future, maybe you lost your job, the important thing to note is that sometimes it is best, or not sometimes, all the time, it's best to reach out to the financial institution. A lot of times they have things in place because we know life happens. And so if you go to them first and say, hey, this is what's going on, they might be able to work out some kind of payment plan before the fact, before you falling behind. I know me coming from branch, I had a lot of people that they would come in and it would be too late. And I would tell them, I know it seems scary. I know it's going to seem like we're going to be like, oh, you're not paying on your loan and we're going to take you out. It's not really that, since we want to help you as much as you want to be helped. So it's just important to know, seek out for help. Even if your collection agency, even if it feels like it's too far gone, if you feel like you can't make those payments, reach out and let them know, hey, right now it's a little bit of a hard time and I can't pay that full amount. It's always reaching out and speaking up. which I know sometimes it seems like it's a scary option and nothing is going to happen, but in many cases, people are willing to help.
Good points, Jennifer. Thank you. And that leads us to our first question before we get into this information here. Do you ever wonder how $40 of fast cash from the ATM can disappear so quickly? I'm curious about your responses, Jennifer. I don't know if you want to monitor the chat for that one, because I think that this question here just draws out more about how easy cash goes, right? You know, I always think about for myself how easy I let go of cash when it's physical versus on my debit card. I can track it on my debit card. I can't track it on my, if I have it in my pocketbook or in cash. So are there any answers for how quick that goes for someone?
Actually, I'll share mine really quick. I
Sure.
remember, I think I went to, I think it was just a few days ago, I went and withdrawed like $40 from from the Publix ATM. I went inside and I came back with like $1. Because it had groceries, right? So we had all those things, and like you said, you don't really keep track of it. And it's like, okay, there goes that $40, and we know how obviously prices on groceries is just increasing, and you may see a few things in the store that you may not obviously consider not buying, but now you bought it because you have the cash for it, right?
Yes, I've been guilty of that, Giselle, so many times. So I
Yeah,
see,
we have in the chat where they're saying within a few days, sometimes within a few hours, especially if you have teenagers. They said it's like magic, a disappearing trick. So definitely, I know for me, I don't carry cash. And if I carry cash, it's big bills because my heart hurts when I have to break $100 bill. If it's a 20, all of a sudden I throw it in some, oh, I'm eating or I'm spending on some clothes, and I don't see the 20s leave my wallet. I don't see the 10s leave my wallet. The 100, I do. So it's a whole mind game for me.
yes, teenagers and their never ending.
Never ending expenses. Yes.
I agree with Fatima. She's so right about that. And I love talking about the realistic things that happens because we do set ourselves up for success most of the time. But there's a psychological dealing with that, right? And I think that you hit it on the nail, Jennifer, when you expressed, you know, that 100 versus the 20, the 10s and the 5. In your mind, you think, I'm spending more if I break the 100, but you're spending as equal if you use the 20 and the 10 and the 5 all in your wallet. And that 100 that you're saving, you know, you just saved half of that accidentally because you got into the rest of it. So what we're saying here is creating a habit on how to manage that cash flow, writing it all down, keeping receipts, using credit or debit cards. This helps you track. For me, I think that the biggest thing here is receipts. Your receipts, if you keep on to them, whether you utilize them in a successful manner, you know, to go back and reassess where your spending went, or if you just look at them, both ways, you'll be able to track and see where your spending goes. And I always say yes to receipts. I get the question all the time, you know, from gas, fueling, or at a quick stop for Wendy's, whatever it is. And it's, do you want your receipt? Yes, I want my receipt. I want to see what I spent. Creating that habit will help you understand how that goes. Using a credit card, when you have something handy and electronic, it helps you record those events, right? Where that flow of cash went, and it helps you see that a little bit easier. And, you know, sometimes there are technology in place where that intelligence helps you even add that all up. What went to entertainment, what went to cash, what went to regular spending, and you get to see that in those technology examples when we use a handy electronic like a debit card or a credit card. Monitoring our ATM use, how often you go and how quickly you get cash. You know, we see that ATM as a quick access. How quick can I get cash? How quick can I, you know, take and, you know, even the screen is set up so like quick 20, quick 40 at times, quick cash. Monitoring yourself at that, you know, maybe keeping a partner to help you assess that situation. Maybe that's your spouse, maybe that's your partner, maybe that's just someone that's involved in your finances, a life coach to help you see how these little habits really add up and take away from that cash flow that we're talking about here. You can use a lot of things like computer tracking programs. I learned and look at this like apps. There's so many apps now that can work for us. Instead of us working harder, right? Work smarter, not harder. And sometimes we don't do this tracking because we see it as, I don't have that time to carve out of my day of, here's another task, here's another habit I have to change. So it's so much harder to, overcome that. But if you use apps and you're okay with that, apps can do it for you. You can insert those receipts, you can insert your habits as you go through them, or even write down, from your notebook what you did. And those apps tell you this is where your money's going and adds it all up. And it's a huge shocker. I'll tell you from experience, it's a shocker. It makes you feel the cash flow, and it just draws awareness. So it's not about making you feel bad about how poor of a spender you are, or how best you can save. It just is to draw awareness to where your cash flow is. It's the conversation here.
So we do have a question. I don't know if you are able to unmute yourself, or you can drop it in the chat. Richardson, last name Richardson. Feel free to drop it in the chat. But as she said, it is very important to just track your spending. Sometimes if we take a look, I had a coworker where she track her spending and just little transactions between now and then, and she was able to see how much she was spending on coffee, like Starbucks, at Starbucks, which added up about $500 a year that she was spending. Which in the moment you're like, oh, like it's just $5 here and it doesn't matter, but it does add up. I know for me it was just spending. I love shopping, so I would go to TJ Maxx, and in my head I'm like, oh, it's everything is cheap, except the $7 here and the $5 there and the $10 there would add up by the time I got to the cash register. So it's really just tracking where you're spending, because maybe you ate here and it didn't seem like much, but if you're eating 3 times a day out or 3 times a week, those do add up.
Yeah, so those little expenses start to add up and start carving out your wallet, your digital wallet, wherever you keep your funds and manage it from, it chips at it. And I saw here one of the answers, $40 goes in gas, especially nowadays with gas being almost $5, right? I think that we get half a tank at that barely, because gas prices are so high. So it really takes a toll, right? And we know that. So I think that prioritizing spending, which leads us to our next slide here, for living within what matters. What matters is our means, and our means is what can we live with and what can we live without? That question, and it's a really hard question, right? Because when we look at what we want it for a reason. And so to build the rationale around this is why I want what I want is very easy for us, because we made that decision very quickly in our subconscious when we made that money decision. And I've learned that you can increase your income when you work overtime. You can get a part-time job or a better paying job, to increase your income. You can apply for a promotion to increase your income. And you can also sell assets to pay down any debt, with going back to what Giselle advises on for money management, maybe combining your debt and paying it from one source. This is also known as like transfers of debt, consolidation of debt. All of those are ways that you can increase your income because your payment is reduced with needing just one source to pay it from, versus paying to so many sources and paying finance on that, and that increasing your payments, right, when you add it together. So these are all options on how you can live within your means and increase your your income. Prioritizing your spending is a little bit different. We look at prioritizing spending when we try to reduce and eliminate. So reducing, substituting, postponing, and forego are all things that remind us about what is priority, what is something that is consider discretionary expenses. Can you live without it, is what I like to say about discretionary expenses, because those are gray, right? You don't need them. You need things like to pay your bills, right? Your light, your water, your rent or your mortgage, your car payments, your credit cards, because we understand that this all involves the conversation about building credit and understanding that. So analyze what you can postpone and what you can substitute. Something as easy as substituting the way that you consume coffee. A big coffee drinker, speaking from a coffee source, that example about Starbucks, $40 on Starbucks, I can make maybe 6 trips to Starbucks. I know that for a fact, because a cup of coffee at Starbucks or any place is about $5, I think, at average. And so you consider the taxes and then, what else you buy when you stop for a cup of coffee, it becomes a lot, right? You're there already, so it's convenient to get that cake pop, to get that pastry, whatever it is. So maybe if I postpone my coffee, if I substitute it, postpone and substitute for sure. But if I substitute it for making it at home, I can purpose a Bustelo package. It costs me maybe $3 to $5, and it will last me about 2 weeks if I make coffee every morning. And I'm making a substitution there. I'm not letting go of my coffee because I need my coffee in the morning, but I'm substituting the cost. And so cost is what we're wanting to substitute in this example. I don't know if you ladies have any other examples that can draw on the means for living.
Yeah, just to know, when we say living within your means, this might even mean in terms of a loan. Sometimes you might be approved or pre-approved for maybe 30,000 or 40,000 for a vehicle, and it seems great, and you're like, yes, I can get that dream car, I can get that dream. In a aspect of a mortgage, you might get approved for well over what you were looking for. But it's really taking a look at your finances and seeing, what can I afford? Because sometimes your lenders aren't going to have your best interest. They don't know everything that you are spending on. So it's looking at, maybe I don't need the newest car right now, I need a functioning car. Or yes, I want that dream house and I'm able to afford it. So it's looking at what expenses you have, because again, your lenders don't always have your best interest, and they might approve you well over what you were in your mind. You said $20,000, that's what I'm looking for, that's what I can afford in terms of monthly payment, and your lender goes ahead and approves you for 50,000, and you're like, oh wait, 50,000 covers that newest car that I really wanted. So it's really just kind of reeling it in and saying, is this something that I can afford at this time? Because those are the decisions that will lead, if you're not able to cover those expenses, might lead to a situation where you're encountering financial hardship.
Said, Jennifer, thank you for those points. And excessive debt, it can derail our budget. Moving on to our next conversation here about deleting your debt, it's also in that decision making, like Jennifer, you just introduced, right? If we try to live a cash only lifestyle, close accounts you don't need and keep emergency cards at home is one way to look at that. That helps in your decision making at the situation. A lot of our incurred debt comes from situational. You're under duress about a situation, whatever that may be, and you think of, where can I go for that lending conversation? Where can I obtain, the most finance to cover this and another situation like this? If you start to delete debt from memory like that, relearn or unlearn those habits that cause you to increase your debt by gaining new debt and making those payments again, that's the start of having that mindset to understanding credit. I think that oftentimes we think of credit, obtaining credit and improving credit go hand in hand, and that's not so. We want to see, from a financial institution perspective, you deal with the debt that you have, manage that well, rely less on it, like Giselle mentioned, with your own cash flow. And so that's that lifestyle of living at cash only, trying to live that. We know that's almost impossible sometimes, but trying the best that you can so that you don't have these increased payments. And just from our notes here, when we increase that debt, we increase our payments. That just means that you have more payments to follow through. And that induction of payments can also happen from a place of need, but it can also create bad habits or accidents, like forgetting to make a payment. I think I hear that so often. I have so many credit cards or so many loans and I forgot to pay. And that happens because you come to a place where it's unmanageable when you incur too much. Using your credit rating is good to ask for better rates from your lenders. Jennifer talked about those lender conversations and perspectives, and we're at that too when we're rating credit. We're rating it from how you understand credit. Do you obtain a good rate versus a poor rate? That also shows you as a borrower how you understand and manage credit, because if you're obtaining poor rates, we can look at that as you may not understand how this is affecting your score. Maybe your understanding of this is low. So, all of this not only portrays you, but also affects that overall FICO, because we know this, right? The higher the interest rate, the less you're paying to principal and the more interest and payments you're making. I want to make a clause here. I saw a chat come up, Jennifer or Giselle, if you want to speak on that.
Yeah, so Jen had mentioned, so if I pay off my credit cards and have no balance each month, would that increase my score each month? So to go off, so if you're paying off your credit card each month and you have a balance next month, then yes, that's fine because you're constantly using your credit card. If you pay it at the end of each month, that's fine. That's good actually. And then you reuse it again next month and you do the same thing, that will increase your score, because what it's doing is that you're still using your credit. I would say if you're using your credit card and you're paying it off and you're not using it for like a couple months, then that's not really increasing your score. You want to make sure that you have movement. As long as you have movement each month throughout your credit card, even if you paid at the end of each month, it will definitely increase your score.
Yes, I agree with you, Giselle. I also think of, how can you show your character to the reporting bureaus and your score if you're not managing that and showing that management? It's not touched and it's still, and that's good. So it doesn't report negatively, but it doesn't increase your impact of your FICO as it would, like Giselle said. Good points. Any other questions while we're here? All right, so when we're also considering repayments, consider making repayments to, those credit cards, those loans with, low interest. So an example I have here is a home equity to pay off high interest credit card or debt. This is an example of a more advanced transaction when we're considering our management of credit. So using extreme caution with this option, again, low interest home equity to pay off a credit card helps so that defaulting on a loan secured by your home can result in foreclosure. So also think of the collateral damage, literally, that can occur if you don't manage your credit by understanding it well. Sometimes, and Jennifer, you spoke from this place of what lenders will deem solutions isn't always a solution for you. Exploring solutions from a credit place, a place of, fostering your credit by taking care of what you have and also not losing your assets like that collateral, your home, is extremely important so that how does this work? How does it look in a different light? It's super important to do that. I was looking at the question here. Yes, we did. I think that we did answer those questions. I'll leave that to you, Jennifer, to look at the chat. We did get something in there.
Okay. Jen said, example, I paid my balance in full for the past 2 months. My credit card reported my balance before my payment was made. So even though I paid in full, my balance was sent to the credit agency. So whether it reported or not, the thing to keep in mind is sometimes it reports, but that doesn't necessarily mean that it's negatively affecting you. It's just showing you have a balance on that card and that you're utilizing it. So it's really important. What's important is more so paying that off so that you know that you're not incurring interest. More of a benefit for your side in terms of seeing your credit report. It's showing that you paid it off and that there's no, even if it's that minimum payment, you have paid that balance off. So even if you've paid it full and it shows that it has a balance, it's not negatively affecting you because it's actually showing that you're utilizing that credit card.
Yes, and something also to consider with every credit card, there's a cycle period. So if you care about the way that it reports, it's important for you to know what that cycle period is, which means how often does this credit card report to the credit bureau? So it's different for every financial institution. I can speak from Suncoast, and that's one example, but we have a period where we will report on our credit cards and our members' use of those credit cards. And if our members are aware of their payment cycles, they can meet that period, air quote, of needing to satisfy that balance in full. So we report it in full. But like Jennifer said, it won't take too much away from what you've built, because again, if you pay that back and it reports the next time in full, it's still a positive, return to your FICO score, because you are not decreasing the balance, but decreasing the use, of what you just did. So it just depends on what you're wanting to achieve with that question. I kind of heard it two-part, where if you are wanting to achieve it that it's paid in full and reported in full, then maybe you need to learn when is that reporting, and a payment, like a schedule of payments, can tell you that. If it's not with Suncoast, that financial institution should be able to tell you. If it is with Suncoast, we could definitely tell you when you inquire within. Does that answer that question?
I'll keep a lookout.
Thank you. So for participating exercise here, and I know that we have a few minutes to spare, when we're reviewing the cost of credit, it's important for us to look at a few things, right? And so my first example here is, let's consider a $5,000 debt plus an 18% interest plus a $100 payment. That can equal 7 years, 9 months, and a total of $9,311. A second example is the same $5,000 debt, an 18% interest, a $150 payment. This would look extremely different to 3 years, 10 months, with a total spent of $6,983. The third to last example of $5,000 debt plus a 10% interest plus a $100 payment, giving you 5 years and 5 months, payment of $6,495 spent there. And the last example, $5,000 spent plus a 10% interest plus a $100.50 payment, giving you 3 years and 3 months at a total of 5,882 payments. Now, based on those examples, what do you think?
So they're saying that they can't see the slide, and there's not a slide. It's just showing you how making payments in a lesser time is going to help you in terms of interest. And then Jen did kind of explain or expand on her question and stated that her daughter makes her minimum payment each month on her credit card and has it maxed out. I paid my balance in full, but our score seems to stay the same. I'm trying to desperately get my score up. So really, it's one of those things where you can't know for sure. And I know that maxing out your credit isn't the very best, but maybe it's making more payments sporadically throughout before the monthly payment is due to keep that balance lower. So maybe that's more of an option instead of maxing it out and paying it at the actual due date. And then they're saying number 2 and lowering your APR also. Oh, okay.
Yeah, I wanted to expand on that question that we got here about habits when she's comparing her daughter and herself. Now, let's keep in mind too that no two FICO scores are the same. You know, Giselle mentioned the age of the credit file. So your age, you know, may be lengthier or shorter than your daughter's. I would assume her being your daughter, maybe not. But also, you know, it could mirror the same in terms of just the time that it's captured. So you're looking at her credit and your credit and seeing it with the same eyes of score, but there's other factors into that. So, you know, what other trade lines you may have that are also contributing to that FICO score could keep you at the same score as your daughter. Your daughter starting off, you know, building that score for the very first time and how she's dealt with that can, you know, produce maybe that close proximity. But I would maybe steer away from how are we paying together and how does it keep the same? Because there's a lot to do with those factors. And Giselle talked about that annual analysis. If you wanted to really explore why your score is similar, myannualcreditreport.com can help you achieve that credit report without the credit score. And it tells you where that score is modeled from. Is it from your payment history? Is it from maybe derogatory, closed accounts, settlements, what you currently have, maybe your debt to income ratio? That's the terminology we use for, you know, increased debt versus your income. Do you have the income and what it takes on paper? Does it look like that is suffice or enough for those payments? It's a ratio. It's like a mind game that they make us for those credit bureaus, but it has a lot to do with why your credit is. So I think that my annual credit report will help you see that a little bit easier. Thank you for that. And for the best option here, we want to consider that our $5,000 debt, the 10% interest with a $150 payment at 3 years and 3 months, with the lowest repayment at $5,882 being that best option for you, because it's the less interest, which will produce less financing and less payments to that debt of $5,000. Remember, we started with $5,000. So to pay $9,311 or anything more than the $5,882 example is what you're paying in interest. And so when we see that at double, it's not okay. And I think that sometimes we conform to, well, you know, we're always going to pay interest and we got to bite the bullet. But what we want to teach here is that you don't have to. So for what you can do today is to get involved with your credit score. Ask for that help, whether your partner, your spouse is involved or not. Definitely get involved the people who are supposed to be involved, and seek that advisor. That advisor can be your trusted advisor at your financial institution to speak on what your current climate of your finances looks like from that perspective and how you can decrease your debt. When you come into that, how can I decrease my debt mode? It will absolutely help you and start that conversation for you sooner. For the next 3 months, something that you can do to jumpstart is to change your habits. Changing your habits immediately is hard, right? Speaking from a human to a human conversation here, but they say 21 days can help us achieve a new habit or change habits. So if you heard anything today that you know you don't do, it can help you, and it will help you if you just make those micro habit changes, right? And it's just telling your mind to operate differently, and then it will produce that new habit for you if we're doing any of the things that we mentioned. And, you know, we've all been subconscious about it. It's a conscious decision each day. You know, I always think about, do I open my blinds and leave home so that maybe less air circulates out of my vents? You know, that's going to increase my light bill. Those are subconscious habits. You know, we might close it because it's a thing to do, but I've learned that's my light bill that I'm making a decision for, right? And the third one here, I'm sorry, just I can't see it on my screen. Oh, what can you do this year? Make a plan. Make a plan for what's your goal? What's your goal at the end of this year? What do you want to achieve by the end of this year, at the start of next year? What can you do in 3 months, 6 months, 9 months, the end of the year? Pave the way for yourself, carve the time, be conscious about that, and start to save for those unexpected. And I think in the times that we're living now, those unexpected moments can exist. So preparing for that is always the best way to preserve your credit, because you don't want to take from your credit score or anything else for that matter. So that's all we had for you today in terms of our discussion. Thank you for using the chat and spending the time with us. I do want to open the forum to that panel that we see here for questions. I see that there's one. You also, does a credit score, personal medical bills affect credit in different ways? Great question, Jen. Yes, it does. Yes, it does. A credit score, a personal loan, medical bills, they do factor into that FICO differently because of their source. So I would loop credit card and personal loans almost together. A personal loan, I would say, is it close-ended? Is it open-ended? Open-ended loans mean that they stay revolving. So as long as you have that open and you use it, the same habits that we talked about today, it continues to report well. Whereas a close-ended loan, in that personal loan example, will at one point cut off your reporting of how you're making that payment. And I think that oftentimes how we purchase these products, request them in loans, when we make those decisions to make it a close-ended option, it can actually counteract what you're trying to achieve. So speaking from a solution-based conversation for what you want to achieve from the loan, is the loan to temporarily aid something? Is it something that you want to have in the future should you have access to it again? Maybe a revolving personal loan is better, like a personal line of credit versus a loan, because yes, if it's close-ended, and those personal loans usually are, it's at one point it's going to dissolve once you pay it off, and it will stop that trade line report. Medical bills, they taint your FICO score. They remain there as long as any trade line, it's what the services that you requested renders limit you if you don't pay that back. It is a judgment against that, but from a financial standpoint, we do hold discretion very vaguely to credit and personal loans. So it just depends on how much it is, the balances owed, the age in, again, what you have. So if you're asking from a place of, does it affect credit in different ways? Absolutely. And that brings us to balance here. Balance is a great financial education tool that we really rely on at Suncoast for our members and our team members to continue to deepen our knowledge about how our financial actions and our options in this industry that we're in helps us to achieve our financial soundness. So in balance, you can explore how each of these credit card, personal and medical bills affect your score. We have e-learnings, we have pamphlets, brochures, and you can even create little puzzle learnings for yourself based on your personal needs, and it's completely free for our members. We also offer to our members an option to call toll-free, and these advisors are financial counselors. Their purpose for our members, and we assume those costs for you so that you can talk and continue that conversation that could start at Suncoast or maybe from this conversation that we're having here. So it's a great tool. I'm just looking at the chat here. It says, thank you so much. This was great for me and my team. Yes, thank you for your questions. I think that draws for perspectives and, us being able to expand. IFL transfer balance is used as check that banks send me with 0 for 18 months affect my credit.
I think that's those checks. I'm not familiar with those checks, but if it's borrowed money, yes. If it's ever a check that they're giving you money in advance, I'm thinking that's more like almost like a loan. So that will affect your credit. Yes, anything tied to credit does. And then if I am not paying interest and all my credit cards are paid timely, does it affect my FICO score negatively? No, it does not. For how long? Short sales still in my credit.
is a short sale on a mortgage? Is that what the question is from, Esteban?
I believe it's a short sale from a mortgage.
So that's a really big question without looking at your, entire picture. You'll learn from a Suncoast perspective that we look at the entire picture to advise you. So if the short sale happened, due to a bankruptcy, due to a hardship, due to, any reason for the non-possibility of being able to pay, then it could affect your credit. I would say that myannualcreditreport.com would help you see how it impacted your credit in real time today, where your credit stands. So if it's still in your credit, it would just depend on what time did it make it there. Usually judgments last, and we went over that a few slides early, 7 to 10 years, depending what it is. I would stay away from closing credit cards if they're paid in full. Usually bank accounts don't produce credit, so you don't get credit from holding bank accounts unless they're tied to credit cards, like a secured credit card holding a balance from the account. It would be affected if you close a card that you have paid well and you have good history on, and it's your longest trade line. That would be an example of how it couldn't affect you. Good questions, Esteban.
Right. Well, thank you all so much for being with us tonight. Thank you all, Suncoast Credit Union, for always doing such an amazing job with helping us with our finances. We are so appreciative of this relationship, this partnership. You are not only educating the families of Hillsborough County, you're also educating us as well. So thank you, thank you, thank you. And with that, everyone, we are always glad that you've joined us. Again, we put our YouTube channel in the chat, so if you want to go back and review everything they've said, because it was a lot of information, it's going to be posted tomorrow. You can visit it on our YouTube channel, and if you subscribe to the channel, then you will get a notification when it's posted. All right, with that, we want to thank Jennifer and Ashley and everyone here for presenting such wonderful information. And with that, I want to tell everyone, have a great evening. Good night.